my complete NAS100 liquidity strategy. From market open to entry, step by step. Most traders look at NAS100 and ask one question: is the market going up or down? But that might be the wrong question. Because before NAS100 makes a major move, the market often needs liquidity. There are traders sitting above previous highs. There are traders sitting below previous lows. There are breakout traders waiting for price to push through a level. There are stop losses sitting around obvious highs and lows. And when enough orders accumulate in one area, that liquidity can become a target. This is where things get interesting. Instead of trying to predict every candle, we're going to study where liquidity is resting, how price interacts with it, and what happens after that liquidity is taken. In this video, I'm going to break down a complete NAS100 liquidity-based trading model. We'll cover how I prepare before the NYSE Open, how I identify important liquidity, how I distinguish a real breakout from a liquidity sweep, how I use market structure for confirmation, where the entry can come, where the stop loss belongs, how I determine the target, and most importantly, when I stay out of the market. Because having an entry model isn't enough. You also need an invalidation model. You need risk management. And you need the discipline to do nothing when your setup isn't there. So let's start from the beginning. 2. What is liquidity? Before we build the strategy, we need to understand the concept behind it. Liquidity, in simple terms, refers to areas where there is a concentration of orders. On a price chart, we're particularly interested in areas around obvious highs and lows. For example, imagine a NAS100 creates a high. Price pulls away, then later comes back toward that high. Above that previous high, there may be stop orders from traders holding short positions. There may also be buy stop orders from traders waiting for a breakout. That means the area above the high can contain significant buying interest. The same principle can happen below a previous low. Below that low, there may be stop losses from buyers and sell stop orders from breakout traders. So we can think about these areas as liquidity pools. And this gives us an important concept. Price doesn't move randomly from one candle to another. There is an auction happening. Orders are being matched. Liquidity is being consumed. And sometimes price moves through an obvious high or low, triggers those orders, and then quickly reverses. That's what traders often call a liquidity sweep. But here's the critical part. A sweep by itself is not an entry signal. This is where many traders make mistakes. They see price take a previous high and immediately sell. Or they see price take a previous low and immediately buy. That's not enough. We need confirmation. The liquidity sweep tells us, pay attention. The market structure tells us, now we may have a reason to act. That distinction is extremely important. 3. Why the NYSE Open matters. Now let's bring timing into the strategy. NAS100 trades throughout the day, but the US cash session open can bring a significant increase in participation and volatility. For our strategy, we're interested in the period around the NYSE Open. But we're not simply opening a trade because the clock hits a certain time. The time is a filter. The price action is the confirmation. Before the open, ask this: where is the recent high? Where is the recent low? Where are the obvious equal highs? Where are the obvious equal lows? And which side of the market appears to have the most obvious liquidity? This preparation matters because once volatility increases, NAS100 can move very quickly. If you enter without a plan, you can easily find yourself chasing the move. And chasing is exactly what we want to avoid. For the pre-market map. Before looking for an entry, we build our map. Think of the chart as a battlefield. We're not looking for a trade yet. We're looking for information. First, identify the most relevant recent swing high. Then identify the most relevant recent swing low. Next, mark any obvious equal highs or equal lows. These levels matter because traders naturally pay attention to them. Then look at the current price. Ask, is price closer to buy-side liquidity or sell-side liquidity? If price is sitting below an obvious high, we know there is potentially liquidity above it. If price is sitting above an obvious low, we know there is potentially liquidity below it. Now we have a framework, but we still don't know what price will do. And that's intentional. We don't predict the sweep. We prepare for it. If price takes the high and then gives us bearish confirmation, we can look for a short setup. If price takes the low and then gives us bullish confirmation, we can look for a long setup. And if neither happens, we don't force anything. That's one of the most important rules in this entire strategy. No setup means no trade. 5. The liquidity sweep. Now let's look at the event we're waiting for. Suppose NAS100 has created a clear previous high. Price approaches that high around the NYSE open. Then price pushes above it. A lot of traders immediately think, breakout, buy. But we don't react that quickly. We watch what happens next. If price breaks above the high, fails to hold above it, and then begins showing bearish market structure, the breakout may have been a liquidity sweep rather than the beginning of a sustained bullish move. The same thing works in reverse. Suppose NAS100 has a clear previous low. Price pushes below that low. Some traders immediately sell because they believe the market is breaking down. But if price quickly reclaims the level and then produces bullish structure, we now have a different story. The market may have taken sell-side liquidity and then reversed. Again, the sweep is not the trade. The sweep is the event that puts the market on our watch list. The confirmation comes next. 6. Confirmation with market structure. This is where boss and chalk become useful. Let's take the bearish example. Price sweeps a previous high. Instead of immediately selling, we wait. We want to see whether sellers can actually take control. One way to look for that is a bearish change in market structure. If price starts breaking meaningful short-term lows after the sweep, we have evidence that momentum may be shifting. That's much stronger than simply seeing a wick above a previous high. For a bullish setup, the logic is reversed. Price sweeps a previous low. Then we wait for bullish structure. If price begins breaking meaningful short-term highs, that gives us evidence that buyers may be taking control. So our sequence becomes: liquidity gives sweep gives structure gives entry, not liquidity gives click buy or sell. That difference can completely change how you approach the market. And now we have the foundation. We know what liquidity is. We know why the NYSE open matters. We know how to build our pre-market map. We understand the liquidity sweep, and we understand why confirmation matters. But we still haven't answered the question every trader eventually asks. Exactly where do I enter? That's where the actual execution model begins. Part 2. Entry, stop loss, take profit, and invalidation. So now we understand the foundation. We know what liquidity is. We know what a liquidity sweep looks like. And we know why we don't enter immediately after the sweep. Now, let's get into the part most traders actually want to understand. Where exactly do we enter? Where does the stop loss go? Where should the take profit go? And when do we admit that the setup is simply wrong? Let's break the entire execution model down step by step. 1. The exact entry model. Our basic sequence is: liquidity gives, sweep gives, displacement gives, structure break gives, retracement gives entry. I want you to remember that sequence, because if you skip several of those steps, you're no longer trading the model. Let's start with a bearish example. Imagine NAS100 is trading below a clearly visible previous high. That previous high represents potential buy-side liquidity. The NYSE session opens. Price pushes above the previous high. That is our first event, the liquidity sweep. But we don't sell yet. Now we want to see what happens after the sweep. If sellers enter aggressively, we may see a strong bearish move away from the high. That's what we can call displacement. The market isn't just slowly drifting lower. We're looking for evidence that price has moved with intent. Next, we want to see a meaningful short-term low get broken. That gives us our structural confirmation. Only after that do we start looking for the entry. And this is where patience becomes important. Instead of chasing the bearish candle, we wait for price to retrace. The retracement can return toward an area created during the displacement. Depending on how you define your model, this could be an imbalance, fair value gap, order block, or another clearly defined reaction area. The important point is this: we're not entering because price moved. We're entering because price moved, confirmed the shift, and then returned to an area where we can define our risk. 2. Bearish entry example. Let's make this extremely simple. Imagine NAS100 does this. Previous high, 18,500. Price trades toward that level. Then NYSE opens. NAS100 pushes to 18,530. The previous high has been taken. Instead of continuing higher, price aggressively reverses. Then price breaks a meaningful short-term low at 18,470. Now we have liquidity sweep, bearish displacement, structure break. At this point, we're interested in a short, but we're still not chasing. Suppose price retraces toward an area around 18,495 to 18,505. If that area fits our predefined entry model, we can consider the short there. Our entry could therefore be around 18,500. The exact price is not the important part. The process is. 3. Where does the stop loss go? This is one of the most important parts of the entire strategy. Your stop loss should be placed at a level that invalidates the trade idea, not at a random number, not simply because you want to risk $20, and definitely not simply because the stop looks small. For the bearish setup, if our thesis is price swept the high and is now rejecting that liquidity, then a move back above the relevant high can invalidate the idea. So our protective stop could be placed above the sweep high with an appropriate buffer for the instruments, volatility, and your broker's execution conditions. Using our example, entry 18,500, sweep high 18,530. You might place the stop above that invalidation point rather than directly on it. For example, stop equals 18,540. That creates a 40-point theoretical risk. Again, this is an illustration, not a universal NAS100 stop size. NAS100 volatility changes. Your stop should be based on market structure and risk, not on a fixed number of points. 4. The most important stop loss rule. Here's a rule I want you to remember. Never move your stop farther away just because you don't want to take the loss. If the market reaches the level that invalidates your setup, the trade is wrong. Accept it. A trader's job isn't to make every trade profitable. A trader's job is to make sure that losing trades remain controlled. You can lose several trades and still have a profitable system. But if you allow one losing trade to become enormous, you can destroy the mathematical advantage of your entire strategy. 5. Position size comes after the stop. This is another major mistake traders make. They choose the lot size first. Then they try to find a stop that fits the lot size. We want to reverse that process. First, where is the invalidation? Second, how much am I willing to risk? Third, what position size corresponds to that risk and stop distance? The formula is conceptually simple. Position size equals risk amount divided by stop loss value. The exact calculation depends on your brokers. NAS100 contract specifications, tick value, contract size, and account currency. That's why you should verify the symbol specification on your actual trading account before placing the order. 6. Take profit logic. Now let's talk about the other side of the trade. Where do we take profit? A common mistake is choosing a random target like, I'm going for 50 points. That's not necessarily logical. Instead, we can use liquidity and market structure to determine where price may have a reason to react. For our bearish example, we swept buy-side liquidity above a previous high. So after the reversal, we can look toward areas of sell-side liquidity below price. For example, previous low, 18,400. If our short entry is 18,500 and our stop is 18,540, our theoretical risk is 40 points. If our target is around 18,400, that's 100 points of potential reward. That gives us 1 to 2.5 risk to reward. But here's the important distinction. 7. The target hierarchy. When planning a trade, I like to think about targets and levels. Target 1, nearby liquidity. This could be a short-term low or another obvious pool of sell-side liquidity. Target 2, major opposing liquidity. This could be the previous session low, previous day low, or another significant swing low. Target 3, extended target. If momentum remains strong, price may continue toward a larger liquidity pool. But don't assume every trade will reach the biggest target. The market decides. Your job is to manage the position according to the plan. 8. Bullish setup. Now let's reverse everything. Suppose NAS100 has a clear previous low at 18,400. Price trades down toward it around the NYSE open. Then price pushes below it, 18,370. That takes sell-side liquidity. But instead of continuing lower, price sharply reverses. Then it breaks a meaningful short-term high that gives us bullish structural confirmation. Now we wait for the retracement. Suppose price retraces toward 18,405 to 18,415. If that area fits our entry model, we can consider the long. Let's say our entry is 18,410. The sweep low was 18,370. We might place the protective stop below the invalidation area, for example, 18,360. That gives approximately 50 points of risk. Now suppose the next major buy-side liquidity is around 18,560. That gives 150 points of potential reward. That's approximately 1 to 3 risk to reward. Again, these numbers are purely illustrative. The actual setup must come from the live chart. 9. What actually invalidates the trade? This is where many traders become emotional. They enter a trade. Price starts moving against them. Then they say, "Let me give it more room." That's dangerous. Before entering, you should already know what would prove me wrong. For a bearish liquidity sweep setup, invalidation could occur if price reclaims and holds above the relevant high or otherwise violates the structural premise of the trade. For a bullish setup, invalidation could occur if price reclaims the downside and violates the structural premise that justified the long. The exact invalidation should be defined from the structure of the setup, not from emotion. 10. What if price doesn't retrace? This happens all the time. You get your liquidity sweep. You get displacement. You get your structure break. Then price runs directly toward your target without giving you an entry. What do? Nothing. Nothing. This is one of the hardest lessons in trading. You don't chase. You don't increase your lot size. You don't enter late because you're afraid of missing the move. You simply accept. The market didn't give me my entry. There will be another setup. Missing a trade is not losing money. Chasing a missed trade can turn it into a loss. 11. What if price sweeps both sides? This is extremely important on NAS100. Sometimes price takes one side of liquidity, reverses, then takes the opposite side. For example, price sweeps the high. You expect a bearish reversal, but instead, price doesn't confirm. It continues higher. Then later it sweeps another level and produces a different structure. This is why we never build our entire bias around one liquidity event. We continuously reassess the structure. Liquidity is information, not certainty. 12. Full NAS100 trade example. Let's put everything together. Imagine we're approaching the NYSE open. Our chart shows previous high, 18,500. Previous low, 18,350. Current price, 18,460. We identify the high as potential buy-side liquidity. The session opens. Price pushes to 18,530. The high has been swept, but we don't enter. Price then drops aggressively. It breaks a short-term structural low at 18,470. Now we have bearish confirmation. Price retraces to approximately 18,500. This is our potential entry zone. We enter short, 18,500. Our invalidation is above the sweep. Stop, 18,540. Risk 40 points. Now our first objective could be the previous low, 18,350. Potential reward, 150 points. That's approximately 1 to 3.75 risk to reward. Notice something important. We didn't predict that NAS100 would fall. We waited for the market to show us. The market first took liquidity. Then it displaced. Then structure broke. Then price retraced. Then we entered. That's the difference between prediction and confirmation. 13. What if the trade goes in our favor? Suppose our short starts working. Price moves from 18,500 to 18,450 to 18,400. At this point, you need a management plan. Some traders immediately move the stop to break even. Others hold the original stop until a predetermined target or structural condition is reached. There is no single management method that is automatically correct. What matters is that the method is defined before emotion takes over. If your back testing shows that moving to break, even too early, causes you to get stopped out before the main move, then your management rule needs to account for that. Don't change management because of one trade. Evaluate it over a meaningful sample. 14. When we do not take the trade, this might be the most valuable part of the strategy. There are situations where the correct decision is simply no trade. For example, no clear liquidity. If you can't identify an obvious level, don't manufacture one. No sweep. If price hasn't interacted with the liquidity you're watching, wait. No structural confirmation. A sweep alone isn't enough. Poor risk to reward. If the logical target is too close to justify the risk, skip it. Excessive volatility. If price is moving violently and this setup becomes impossible to define cleanly, protect your capital. Chasing. If your entry has already passed, let it go. Emotional state. If you're angry, desperate to recover a loss, or afraid of missing out, you don't have the psychological conditions required for disciplined execution. Remember, the market will always create another opportunity. 15. The complete execution checklist. Before entering a NAS100 trade, I want to be able to answer these questions. 1. Where is the liquidity? 2. Which side was swept? 3. Did price reject that area? 4. Did we get displacement? 5. Did market structure confirm the direction? 6. Where is my entry zone? 7. Where is my invalidation? 8. What is my risk in money? 9. Where is the logical liquidity target? 10. Is the risk to reward acceptable? 11. Am I chasing the trade? 12. Is there any reason not to take this setup? If you can't answer these questions clearly, you probably don't have a complete setup. And that's okay. You don't need to trade every day. You need to trade when your conditions are present. 16. The biggest lesson. Here's the biggest lesson I want you to take from this entire model. Your edge isn't knowing where NAS100 will go. Your edge is knowing what you will do after the market gives you specific information. We don't need to predict every move. We don't need to catch every reversal. We don't need to enter every breakout. We simply wait for our sequence: liquidity, sweep, displacement, structure, retracement, entry, defined risk, logical target. And if the sequence doesn't happen, we wait. Because sometimes the best trade you make is the one you don't take. Now we have the execution model. But there's still a major problem we need to solve. What happens when NAS100 doesn't behave cleanly? What if the market opens and immediately moves in both directions? What if the first liquidity sweep fails? What if there is major news? What if the market is ranging? And what if you take 3 losses in a row? That's where strategy meets real-world trading. In part 3, we're going to cover failed sweeps, fake breakouts, news volatility, ranging conditions, multiple liquidity grabs, and exactly when to stay out of NAS100. Part 3. Failed sweeps, fake breakout, and when not to trade. So far, everything has looked relatively clean. Liquidity gets identified. Price sweeps it. We get displacement. Market structure confirms. Price retraces. We enter. Simple. But here's the reality. NAS100 doesn't care about our textbook setup. Some days the market gives you a beautiful liquidity sweep. Other days it sweeps the high, reverses, sweeps the low, reverses again, and completely destroys anyone trying to predict the next candle. And if you don't know how to deal with those conditions, even a good strategy can be implemented badly. So in this part, we're going to talk about the situations that separate a back-tested setup from real-world execution. 1. The failed liquidity sweep. Let's start with one of the most important scenarios. Imagine NAS100 has a clear previous high. Price approaches it. Then price pushes above the high. We identify the sweep. We're expecting a bearish reversal. But something is missing. There is no meaningful bearish displacement. Instead, price continues trading above the high. Then it breaks another significant high. At that point, the original bearish idea has lost its confirmation. This is where many traders make a critical mistake. They say, it already swept liquidity, so it has to come back down. No, it doesn't have to do anything. A liquidity sweep is not a guarantee of reversal. Sometimes the market takes liquidity and continues in the same direction. That's why our model requires confirmation. 2. Sweep does not equal reversals. This principle deserves its own section. A liquidity sweep is an observation, not a prediction. If NAS100 takes buy-side liquidity, there are at least two broad possibilities. Possibility 1, price takes the high and rejects. Possibility 2, price takes the high and continues higher. We don't know which one will happen beforehand. That's why we wait. The market has to provide additional evidence. Think of it this way. The sweep tells us something interesting just happened. The structure tells us here's the direction the market may now be showing. That keeps us from entering simply because a wick appeared above a high. 3. The fake breakout. Now let's look at the opposite problem. Imagine NAS100 breaks above a previous high. You see a strong bullish candle. It looks like a breakout. Then price suddenly reverses. This is where breakout traders can get trapped. But here's something important. Not every breakout that reverses is automatically a trade for us. We still need our complete setup. We want to see liquidity interaction, rejection, displacement, structural confirmation, retracement, entry. The goal isn't to label every failed breakout as a liquidity trade. The goal is to wait for the exact conditions we've tested. 2. Sweep does not equal reversal. This principle deserves its own section. A liquidity sweep is an observation, not a prediction. If NAS100 takes buy-side liquidity, there are at least two broad possibilities. Possibility 1, price takes the high and rejects. Possibility 2, price takes the high and continues higher. We don't know which one will happen beforehand. That's why we wait. The market has to provide additional evidence. Think of it this way. The sweep tells us something interesting just happened. The structure tells us here's the direction the market may now be showing. That keeps us from entering simply because a wick appeared above a high. 3. The fake breakout. Now let's look at the opposite problem. Imagine price breaks above a previous high. You see a strong bullish candle. It looks like a breakout. Then price suddenly reverses. This is where breakout traders can get trapped. But here's something important. Not every breakout that reverses is automatically a trade for us. We still need our complete setup. We want to see liquidity interaction, rejection, displacement, structural confirmation, retracement, entry. The goal isn't to label every failed breakout as a liquidity trade. The goal is to wait for the exact conditions we've tested. You think short, but instead of continuing lower, price moves toward the middle. Then it takes the low. Now you think long, then it reverses again. Suddenly both sides have been swept. This type of price action can create multiple false signals. The correct response isn't to keep switching directions. The correct response is to recognize that the market may currently be too unstable for your model. Sometimes the best decision is step aside. The NYSE session opens. Price first pushes upward. It takes the high, then reverses. You think short, but instead of continuing lower, price moves toward the middle. Then it takes the low. Now you think long. Then suddenly both sides have been swept. This type of price action can create multiple false signals. The correct response isn't to keep switching directions. The correct response is to recognize that the market may currently be too unstable for your model. Sometimes the best decision is step aside. 4. The two-side liquidity trap. This is one of the most dangerous conditions for an intraday trader. Imagine the market has a clear high above and a clear low below. Both sides contain obvious liquidity. The NYSE session opens. Price first pushes upward. It takes the high, then reverses. You think short, but instead of continuing lower, price moves toward the middle. Then it takes the low. Now you think long, then it reverses again. Suddenly both sides have been swept. This type of price action can create multiple false signals. The correct response isn't to keep switching directions. The correct response is to recognize that the market may currently be too unstable for your model. Sometimes the best decision is step aside. 5. The first move is not always the trade. This is another important concept. Traders often believe the first big move after the NYSE open is the move they're supposed to catch. That's dangerous. The opening volatility can be extremely fast. The first move can be a genuine continuation, a liquidity grab, a reaction to news, a temporary imbalance, or simply the first part of a larger range. So don't create a rule like the first move after open is always the setup. Instead, I wait for my conditions. That's a much stronger rule. 6. What if price sweeps liquidity but doesn't retrace? Let's say we get everything we want. Liquidity sweep, displacement, structure break, perfect setup. But then price doesn't retrace into our entry zone. It simply keeps moving. This is where FOMO begins. You see the market moving without you. You think, if I don't enter now, I'll miss the whole move. Then you enter late. Price retraces. And suddenly your excellent setup becomes a terrible entry. The solution is simple. Don't chase. Your strategy has an entry condition. If the market doesn't give you that entry, you don't have a trade. You have a missed opportunity. Those are different things. 7. News and liquidity. Now we need to talk about news. NAS100 can react aggressively to major U.S. economic releases. Events such as inflation data, employment reports, Federal Reserve decisions, major economic announcements. These events can create extremely fast price movements. And this matters because a strategy that normally relies on orderly structure can behave differently during major news volatility. You may see a rapid sweep, a huge displacement candle, spread changes, slippage, multiple levels being taken almost immediately. That doesn't necessarily mean your strategy stopped working. It may simply mean the market environment changed. So your trading plan should have a news filter. The exact filter should be tested with your historical data. For example, you might decide, I don't initiate new positions immediately before major scheduled releases, or I only trade after the initial volatility settles and my setup reforms. The important thing is to make this a predefined rule rather than making the decision emotionally while you're watching the chart. 8. When volatility becomes too high. Volatility isn't automatically bad. In fact, volatility is part of what creates opportunities. The problem is uncontrolled volatility relative to your execution model. If candles become extremely large and your normal stop placement suddenly creates excessive monetary risk, you need to reassess. Don't reduce your stop simply because you want to maintain your normal lot size. Instead, either reduce position size, wait for structure to normalize, or don't trade. Remember, the market determines the opportunity. You determine whether the risk is acceptable. 10. The almost set up. This is a psychological trap. Imagine your rules require sweep, displacement, structure break, retracement. But today you get sweep, weak reaction, no structure break, then price starts moving. You think it's close enough. No, close enough is how discretionary traders slowly destroy their rules. Your journal should distinguish between a grade setup and almost setup. If your rules aren't met, it's not your setup. 11. When your bias is wrong, here's something every trader eventually has to accept. You can analyze the market correctly and still be wrong about the trade. Maybe you expected a bearish reversal. Instead, price continued higher. That doesn't automatically mean the strategy failed. The important question is, did you follow the rules? If you followed the rules and the trade lost, that's a normal outcome. If you ignored the rules and lost, that's an execution problem. Those two losses should be recorded differently in your journal. 12. Strategy loss versus execution loss. This distinction is extremely important. Imagine you take a valid setup. It meets every rule. You risk your predefined amount. The stop gets hit. That's a valid strategy loss. Now imagine you see a liquidity sweep. There's no confirmation. You enter anyway. The trade loses. That's an execution error. Those two trades should not be treated the same. A valid loss provides information about the strategy. An execution error provides information about the trader. If you mix them together, your statistics become misleading. 13. 3 consecutive losses. Now, let's say you take 3 valid trades. Trade 1, loss. Trade 2, loss. Trade 3, loss. What do? The answer should already exist in your trading plan. You shouldn't invent a response emotionally. For example, your rules might say, after 3 consecutive losses, stop trading for the session and review the trades. Or perhaps your tested risk model allows continued execution. The correct rule depends on your data. But whatever rule you choose, predefine it. Don't increase your lot size because you want to recover. Don't revenge trade. Don't suddenly change your strategy after 3 losses. 3 losses can happen even with a profitable system. 14. The worst days to trade. One of the worst environments for a strategy is when the trader becomes emotionally attached to being right. You enter short. Price goes up. Instead of accepting the invalidation, you think it will come back. Then you move the stop. Price goes higher. You add another position. Now you've turned one controlled trade into a large directional bet. This is no longer strategy execution. It's emotional risk-taking. The market doesn't know your entry. It doesn't care how much you want the trade to work. If the thesis is invalidated, get out according to your plan. 19. The golden rule of this strategy. If you remember only one thing from this entire video, remember this: don't trade the liquidity sweep. Trade the reaction and confirmation after the sweep. Because the market can sweep liquidity and continue. It can sweep liquidity and reverse. It can sweep one side and then the other. It can create a fake structure break. It can move without giving you an entry. Your job isn't to predict which scenario happens. Your job is to define the conditions under which you're willing to participate. That's what turns a chart concept into a trading system. 20. Part 3 Summary. Let's summarize. A sweep doesn't guarantee a reversal. A breakout doesn't guarantee continuation. The first move after the NYSE Open isn't automatically the trade. News can change market conditions. Ranges can produce poor quality signals. Missing an entry doesn't mean you should chase. A valid losing trade isn't the same as a rule-breaking trade. And 3 losses don't automatically mean your strategy is broken. The goal is not to eliminate losses. The goal is to eliminate unnecessary losses. That's the difference. A professional trader doesn't ask, how can I win every trade? The better question is, how can I make sure that when I'm wrong small, and when my setup is right, I'm positioned to benefit? And now we have the strategy. But there's one final layer we need to add. Because a strategy can look amazing on historical charts and still fail in live trading. The next question becomes, Does this strategy actually have an edge? And more importantly, how do we know whether that edge is still working? That's what we're going to cover in Part 4, Backtesting, Statistics, Edge Validation, Risk Management, and how to detect when your NAS100 liquidity edge starts decaying. The complete NAS100 liquidity strategy. So let's bring everything together. If you've watched this entire video, you now understand the framework. We start by identifying liquidity. We wait for price to interact with that liquidity. We don't blindly trade the sweep. We wait for displacement. We wait for market structure confirmation. Then we wait for the retracement. And only when our conditions are met do we look for the entry. From there, we define our invalidation. We control our risk. And we target logical areas of opposing liquidity. But there's something I want you to understand. Knowing a strategy is not the same as having a profitable strategy. You can have a beautiful setup. You can have perfect entries. You can have a high win rate in a few weeks of backtesting and still lose money over the long term. Why? Because the real question isn't, does this strategy look good? The real question is, does this strategy actually have a measurable edge? And that's where things get much more interesting. How many trades do you need before you can trust your results? What win rate does your strategy actually need? How does risk to reward affect your expectancy? What's an acceptable drawdown? How do you know whether a losing streak is normal or a warning sign? How do you separate a bad strategy from bad execution? And perhaps the most important question, what happens when the market changes and your edge starts disappearing? Because an edge can exist today and become weaker tomorrow. That's called edge decay. And if you're serious about trading, you can't just build a strategy. You have to continuously test whether that strategy is still working. That's exactly what we're going to do in the next video. In part 2 of this series, we're going beyond the chart. We're going to take this NAS100 liquidity strategy and break it down through backtesting, statistics, expectancy, drawdown, forward testing, live execution, and edge decay. Because I don't just want to know that a strategy can make money. I want to know why it makes money, how consistently it makes money, and what would tell me when that edge is no longer valid. So if you want to learn how to test a trading strategy like a system, instead of simply believing it because the chart looks good, that's the next video. I'll see you there.